Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, January 25th, 2024. As always, we'll start with the executive summary from today's lit-off morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is the probability of a soft landing continues to rise in the U.S. economy, the end of the BTFP, and the ECB puts investors to sleep. So the nuance here is that the Q4 GDP report out of the U.S. economy beat consensus estimates again, and alongside other indicators, signals the probability of a soft landing continues to rise in the U.S. economy. Specifically, the latest initial and continuing jobless claims data supported our prior assessment of a low probability of a developing recession in the U.S. economy. The 7-month high in yesterday's preliminary January S&P Global Composite PMI reading for the U.S. economy was marginally confirming of that sanguine assessment as well. Elsewhere, effective immediately, the Fed raised the rate on the Bank Term Funding Program loans from 1-year OIS plus 10 basis points to IOER and overnight the rate the Fed pays on excess reserves and confirmed the March 11th end date for the BTFP. Lastly, the ECB did its best to put market participants to sleep by keeping rates unchanged and maintaining previous guidance on its policy rate and balance sheet. Market implications. So while the planned shelving of the BTFP is obviously not a positive catalyst for risk, we do not believe it will be as negative as consensus expects, thanks to offsetting factors, not the least of which is the rising probability of a soft landing in the U.S. economy, which is not likely fully positioned for according to our position model. Also recall that it is a general election year. Unless inflation gets out of control again, the Fed, the FDIC, the Office of Comptroller of Currency, and the Treasury are unlikely to pursue policies that trigger a market crash. Transitioning to 42 macro dashboard here. We'll always start with as always, we'll start with our trading range signals from our friends over at Longbow, getting a near overbought signal here in base metals, getting a near overbought signal in the broader commodity basket, DBC there. I think that was it in terms of trading range actionable trading range signals for today. So we'll wrap it up with a question from our community here regarding the commodities inflection. Hi Darius, in addition to Bitcoin inflecting back to bullish in Tuesday's weather model report, I noticed that it belatedly the commodities have shifted from neutral to neutral from bearish. That is correct. That this is commensurate with PBOC liquidity announcements and a strong moves in both DBA, DBB. DBC is a little lagging, but still moving higher. So the question reads: do we have a potential commodity move of significance building underneath the surface here, particularly in light of this morning's strong GDP report supportive of growth? So great question, astute eye, my friend. So the answer is yes. We recall that in December we put out a note. One of our lead-up morning notes was really featured. Went into a deep dive on sort of the structural and cyclical dynamics in the Chinese economy. And one of the conclusions of that note, the primary conclusion of that note, was investors should expect verbatim. I'm recalling this verbatim. Investors should expect policy support to be front-loaded in Q1 for China. And that's exactly what we're seeing. We're seeing the triple R cut, the 50 basis point triple R cut. It's likely to unleash about $150 billion into the Chinese financial sector. They floated a stock market scheme to promote overseas repatriation of those retained earnings to the tune of about $250 billion. And so the liquidity spigot, or the dial, is getting turned up in China in response to obviously the flagging stock market and the general kind of flagging Chinese economy, and also the deflation that we continue to see in the property sector. So this is all according to plan. So investors should expect a commodity positive price momentum in and across the commodity complex over the medium term. At some point, if commodities get to past a critical threshold that will signal rising inflation and more importantly a permeation of inflation throughout the entire basket, that will obviously be a big headwind for Goldilocks. But obviously, from today's starting point, you don't necessarily have to be overly worried about that. I think we have some ways to go in terms of commodity price appreciation before we cross those critical bearish thresholds for the broader economy vis-a-vis inflation. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, January 25th, 2024. Everyone have a wonderful day out there. Best of luck, and we will catch you here tomorrow. And oh, by the way, check out our Real Vision Daily Briefing from last night. Great show, a lot of great questions from our friends over at Real Vision. I definitely think everyone should check that out as well. So we'll wrap it up there. Have a great day.